Welcome to Navigating the 2026 Cycle Convergence, which is both thematic and timing, with your host, Ron William, FSC Development Director, featuring an exclusive area that was shared at our previous FSC market forecasts. It's so important that we're spotlighting it here, a light version with more to come in future. The picture speaks 1,000 words, cartoon even more, and this is part of the behavioral zeitgeist selection process from month to month, particularly here and now as we start the new year. And the question is ultimately, what is this single or consensus of investors doing, taking a selfie photo of the past trend of 2025, which has been strong, low vol, extrapolating same for the year ahead. And certainly when we look at Wall Street bank forecast, that's what they're looking for. But at the same time, being blindsided about what we can all see, not the elephant in the room, but the rhinos in the room herding all together with the cycle written next to them. And this is very much a potential behavioral risk that is taking place in terms of hindsight bias, but also the blindsidedness of complacency versus asymmetric risk. So let's be aware of the juxtapose here and now, but also keep in mind that cycle convergence is both rare and rarely subtle. Think about the key factors that drive it: growth, liquidity, policy, and geopolitics, all hitting at once or in sequential order. Either way, there is a tidal effect, and that is the very thing that we should certainly adapt to or avoid as much as possible. The risk isn't being wrong, it's reacting late. And you can imagine that whether it's a tidal wave or a cycle convergence, same in terms of the overall risk and effect. The advantage goes to investors who step aside early, not to those trying to time the stampede. Now, a quick disclaimer I want to throw in here. Clearly, here at the FSC, it's all about timing, both in life and markets. So we are, sensitive to that timing of the stampede. But behind that, the nuance is risk management. Behind that, it's due diligence, and behind that, it's ultimately taking a step away as part of that timing analysis. And ultimately, therein lies the edge for this year, for those of you that want to be successful traders and investors. Adapting to the new volatility regime charge is the edge. And there's plenty of analysis on this in terms of how fear beats greed during volatile times, and the risk management benefits far exceed that of maximizing profit. That's been tried and tested both through academia and industry research. I can share more about that in future sessions, but certainly that should make common sense to us all. Let's look at the 2026 cycle convergence and do a deeper dive into the framework, the actual visualization of the convergence, and then most importantly, the likely output of what all of this may be. Now, a quick segue that I want to share with you in terms of analysis and insights that have come to my mind through this latest work. Ultimately, it's suggesting a sequencing of inflections rather than an immediate resolution. This is quite key. Often we look for overnight events or linear moves. Clearly, cycles are non-linear by nature, but we really need to apply that theory into practice and not look for immediate resolutions, something that's binary or overnight. So think about the sequencing of inflections rather than one big move, what that means in terms of each of the cycles, and of course, the actual staging of that process as well. Looking at the cycle framework based on Harvard professor and economist Joseph Schumpeter, who's well known to professional cycle historians, he ultimately researched and repurposed past cycle pioneer work. And you can see here the key cycles that were built on include the kitchen cycle, the jugular cycle, and the Kondrativ wave. the bottom three cycles featured on this chart. Kitchen is the business cycle that we know and love today, especially here at the FSC. It's the flagship cycle that is followed and tracked, but also the one that was popularized by our co-founder, Edward Dewey, as part of the 41-month cycle that is now measurable by the FSC spectral analysis software. So that's 3 to 5 years, but it doesn't just measure business, it also can encapsulate liquidity within that 3 to 5 year range, as well as policy. Keep in mind the presidential election cycle in the US, and this year being the midterm, that typically being mixed performance to volatile reactions as part of the policy uncertainty that typically takes place. So that's your bottom cycle in check. Clearly that topped out early 2025 and perhaps skewed to the right side as part of this very strong bull recovery, breaking new records and certainly surpassing more than most expected, including myself. Here and now, we're likely peaking again into Q1 2026. One cycle up in green, jugular 9 to 10 capital investments. It's a higher fractal equivalent business cycle, often mixed up with the decennial cycle, but different in nature. Again, that is looking like it's peaking and ready to unwind. And I would say one of the most important cycles, but often misunderstood and overlooked, is the contractive wave, 54 years on average. And this is what drives the most important factors in macroeconomics: inflation and debt. Look at the work of hedge fund manager Ray Dalio in his educational thought leadership work, Changing World Order, but also the Great Debt Reckoning. On average, it matches in with the duration of this cycle, but also the components that relate to it. And then lastly, there's a new cycle that has been included in this cycle schema as part of the expanded work that I've been doing at RWA, along with mentor and friend Robin Griffiths, is the macro reset cycle. And that ranges from 80 to 100 years. It's existed since the beginning of time, but it was researched and repurposed by none other than Strauss and Howe. Think about the fourth turning and the socio-economic changes that take place during these structural shifts. This is the big papa tidal wave that really makes the difference here and now. So those most expensive words, could this time be different? Yes, is the short answer, primarily because of this big macro reset chiming in here and now. Now, if you'd like to read more about some of the extended work that has been done in previous years on these key cycles based on adapted Schumpeter cycle framework, look at the Mapping the Market book published by The Economist and co-authored by friend mentor Robin Griffiths, just there on the bottom right-hand side. Now, for those who want to look at the 2026 cycle convergence in action, look no further than the screen dead ahead, where we can visually picture this. This is, of course, driven by a lot of data crunching and testing, and ultimately encapsulating many cycles that chime in within these periods. What we see is the convergence between a time frame of 2026 and 2032. They're the anchor compression periods. What that shares is A, the rare cycle convergence, where multiple macro forces peak or reset together. B, the fact that this historical sign actually demonstrates regime change, not a normal business cycle. So for all of you cycle fans wondering why the cycle's misbehaved or developed some weird skewed signals, that's more than likely why. And then finally, the system transitions from volatility compression, reset to reconstruction. I'll say it one more time. The system transitions from volatility, compression, reset to reconstruction. And for those of you that want a detailed explanation for each of the cycles, I've just put it in there on the bottom right to review post-session as an education resource. Now, let's look at the patterns through history and the echoes that chime through, which can give us a potential roadmap to the here and now. This chart shows you 2 cycle beats back based on the macro 90-year average cycle. It basically suggests that the late stage crisis cycle here and now, using the Strauss and Howe framework, which places today in the closing phase of that 90-year crisis cycle, periods historically marked by financial instability, geopolitical conflict, and rising systemic tail risks as institutional legitimacy erodes. Now, each event risk period has its own variation pattern in terms of the actual backstory that takes place. Look back in history between the 1929 and 1945 period, clearly well known for the Great Depression and the World War years, but also the Bretton Woods reset as part of that new industrial world order. But also one cycle before that, pre-Civil War into the Civil War, between the agrarian economy into the industrial economy as part of the transition between the two, 1857 to 1866. Lots of interesting and insightful historical lessons to learn, but in particular when you apply a cycle framework that matters here and now. So the historical pattern from those prior crisis windows began with financial shocks escalating into geopolitical rupture and resolved through regime resets that redefined economic systems and governance structures. That's the key lesson here of what happened in the past, but also what is predicted for the present and the future. Now, looking at a very popular and related model of changing world order is again based on the work of Ray Dalio, which is being borrowed here to serve the point of the reality of a changing world order. Now, there is a positive reality, and there's one that is a more negative during the rise and then the decline. You can look at the numbers between 13 to 18 to give you a step-by-step playbook of what typically happens, not just to the current unipolar world, which is Western and US-centric, but actually in prior hegemony cycles, which date back to the British, the French, the Dutch, and many more before them. This pattern has happened before and will continue. It's part of life and part of world affairs. Here and now, the super macro cycles warn of late-stage hegemonic regime under stress, consistent with the prior 90-year crisis cycle, as in 1857, 1866, and 1929 and 1945. The dominant power shifts from rule by legitimacy to rule by coercion. For example, financial, political, and military, as institutional credibility erodes. This is the story behind the story of the current headlines. Headline claims of the same, of economic strength, masked deep divergences, narrow speculative capex, AI, defense being two example areas, labor and input constraints, politicized monetary policy. Look at what's been happening with the Fed of late, and inflation risks, which are likely to return in 2026 based on cycle work, but also the quadratic wave that relates to that macro force. Tariffs and sanctions are increasingly used as fiscal tools, reflecting debt saturation and political paralysis rather than strategic confidence. Notice the nuance and notice the juxtapose between the two. Messaging is one thing, but the reality is very different to that. Geopolitically, escalating pressure on rivals and transactional treatment of allies accelerate fragmentation and weaken rather than reinforce the existing order. This is what accelerates the changing world order from a unipolar to multipolar route, and is ultimately what is currently happening here and now. It will take further years to follow, but certainly it's part of the story. Now, as in past crisis regimes, markets may rally intermittently, but volatility, false starts, and policy shocks dominate until a structural reset emerges, likely toward the end of the decade into 2032, as highlighted in the prior cycle work. Now, to put it all together, as part of what is dubbed a cycle transition zone, which is expected to be in 3 stages, we can see right now the cycle convergence, which rarely produces a single turning point, suggests a sequencing of inflections rather than an immediate resolution. 2026 is actually the inflection point where we unwind from exuberant highs down to stress and risk lows. And then we have an oversold rally from 2028 onwards as part of a volatility reset into the new decade. That's what the composite cycle work based on timing indicators, primarily the 90-year macro reset cycle, is suggesting. And this is a measure also of sentiment and risk, not mark-to-market price action, but sentiment and risk. And ultimately, it's something that will be updated and tweaked over time as things change. Here and now, just to close, what this suggests in real market terms is that there is a big rotation between late cycle speculative financialization in terms of asset price inflation that has been the best trade in town. We've all profited from it in some way, shape, or form. Last year was a record run, but at the same time, in parallel, we have seen cross-asset behavior increasingly reflecting this change. From a structural perspective, commodities, particularly precious and industrial metals, have emerged as relative leaders consistent with periods of currency uncertainty and shifting liquidity regimes. Looking to the chart, center stage, we can see that rotation in action live. Precious metals, mining stocks already up triple digits, double if you look at gold, 50 or so percent for last year, silver 70%, and much more when you add the latest record gains. Industrial metals following suit, and then finally energy stocks, which is still early stage. If you want to play catch up with a very attractive risk reward trade opportunity, here it is. And if you look at the FSC exclusive cycle scanner tool, it'll also flag agricultural stocks as another laggard that will likely play catch up. And just to close on energy markets and oil, this stands out as a structurally constrained yet undervalued market, a combination that historically coincided with late cycle leadership during regime transitions, and certainly one to follow. This ETF proxy can be found on XLE for the America ticker. There's the equivalent elsewhere for those of you around the world. And of course, you can look at underlying oil contract. Keep in mind also some of the geopolitical risks that are brewing right now, not just in Venezuela, but also in the Middle East vis-a-vis Iran, and certainly the upside risk that may prevail from that. To close, and the final takeaway, adapting to the new volatility regime charge is the edge. Cycle convergence equals volatility, not collapse. So not a doom and gloom or sell everything here and now. It's just suggesting volatility, new regime, the strong trend, which was fairly complacent and profit making, is likely done. And we have a new environment here and now. Multiple cycles are aligning, historically associated with instability and restructuring before the next expansion. Regime transition underway, a shift toward a more multipolar global and monetary system has been emerging for some time, but more so in the near future. The US dollar remains dominant, but is gradually weakening at the margins. And lastly, position for durability, just to echo the portfolio investment and trading view, commodities, metals, and energy are showing leadership consistent with late cycle transitions. Adaptability matters more than exact timing. Best success in navigating the 2026 cycle convergence. Pleasure to deliver this thematic and timely exclusive feature from our FSC Market Forecast event for 2026. I'm your host, Ron William, Global Cross-Asset Strategist and FSC Development Director. Feel free to shoot me a message on the FSC email available, social, LinkedIn, and Substack if you want to follow my work independently. Thank you and welcome feedback or questions. And remember to hit the like to boost further support for our work. Thank you.
Cycles matter because they show us the future. Nothing else shows us a future path. Nothing that I've ever found in over 60 years of doing this.
Foundation is bigger than markets, right? It started out bigger than markets. It's still bigger than markets. It's bigger than us.
There is no such thing as a black swan. It is merely a cycle that was not forecast or anticipated.
To me, it's huge. If I can get a glimpse of the future, just a little bit of the future, I'm way ahead.
I think that the Foundation for the Study of Cycles has a role to play in both bringing technology to the world, but also really emphasizing agency and human agency.